Welcome, and thank you for joining us for today's webinar, Common Audit Issues. First, I'd like to go over just a few housekeeping notes. All participants will be placed on mute during the presentations, but during the Q&A session at the end, feel free to unmute yourself to ask questions. You can also submit them through the chat function in the webinar app. This webinar will also be recorded. The recording and slide deck will be sent out within a few business days. CPE credit is available to attendees who answer all 3 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 3 polls to be eligible. If you qualify, the CPE certificates will be sent out to you via email within the next few weeks. There will also be a survey that appears on your screen at the end of the webinar. Your feedback is important to us, and we want to provide you with as much value as possible through these webinars. If you take a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey May, we were founded over 35 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. But our experts also believe in the forward progress and success of the industry and dedicate much of their time to teaching and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And now, I'd like to turn it over to your presenters for today, Zach and Shane.
Thank you, Felicia. My name is Zach Blome, and I'm a Senior Audit Associate here on the Mortgage Banking Audit team, and have been with the firm for about 3.5 years now.
And I'm Shane Vado. I'm also a Senior Audit Associate, and I've been with the Richey May Mortgage team for coming up on 3 years now.
Awesome. So thanks for joining us. Today, we're going to be discussing a variety of common audit topics that we feel may be more prevalent in the future with the recent decrease in production. The first topic that I will discuss is accounting for sign-on and retention bonuses, where we're going to focus on the balance sheet implications and the methods of amortization for these bonuses. The next topic I will discuss with you is deferred compensation, where we will focus on stock-based compensation and the various methods to consider when recognizing deferred compensation. After this, Shane will discuss with you the common audit issues caused by CECL and the importance of Scratch and Dent valuations. Lastly on our agenda, we will discuss business combinations and asset acquisitions, the effects that Goodwill impairment has on these, and contingent consideration. All right, so the first topic includes various bonus structures, and these all appeal to different clients and different situations depending on your cash position or how you're operating. We're going to go over some of the high-level accounting treatment for the different types of bonus agreements as well throughout the slides. So the first type of bonus that we're going to discuss is the sign-on bonus. The sign-on bonus caters to an employer that has cash to spend on recruiting and is typically for a valuable employee that the company is incentivized to pay extra money to right away to sign. Depending on the terms of the contract, an accrual may be necessary if a service period is required. If no service period is required in this bonus contract, the bonus would be expensed entirely. And so next, we're going to show you just a couple simple examples of the different ways that the sign-on bonus could be treated. The first example, company number 1 offers a sign-on bonus of $10,000 to an employee with 0 retention period stated in the contract. The employer would then expense the entire $10,000 because there is no retention period. Inversely, the second example, the company offers a sign-on bonus of $10,000 to an employee. However, there's a 2-year retention period associated with the contract. Therefore, the employer would accrue this amount and then expense the $5,000 every single year or for the 2 years. The second type of bonus that we're going to talk about typically comes from a company that is in a position to spend cash to ensure an employee's talent is retained for a certain period of time. In the industry, we sometimes see these referred to as clawback bonuses or within the bonus agreement as a clawback clause. This retention or clawback will usually have the clause stating that the employee will be awarded a certain amount of money up front, but will have to stay through a certain amount of time with the employer. Usually it's a stated number of months or years in a contract. So to show you guys an example of this is the retention bonus example. In this example, company number 3 offers a 5-year retention bonus of $100,000 to retain the talent of an individual. The employer would accrue this amount and then amortize over the 5-year period, expensing $20,000 per year. The last type of bonus plan that we're going to talk about are going to be cash bonus plans with performance or market conditions. The previous two bonus plans we talked about fall under ASC 710, and the difference where things get a little bit more complicated here is that these bonus plans with performance or market conditions can fall under the guidance of ASC 710 or ASC 718, which we'll discuss later in the presentation and go through a little bit more in depthly. The cost of these benefits should be accrued over the period of service when management determines the condition is likely to be met. And then inversely, if management does not feel that this condition that the performance or market bonus was based upon is likely to be met, no cost would be accrued, or if a cost was previously accrued, it would be reversed. So management's responsibility when it comes down to these different types of bonuses, the first thing that's really important is determining whether the conditions of the bonus require the bonus amount to be recognized on the balance sheet. The next important item for management to take responsibility for is to review and apply a consistent method of amortization to bonus contracts. And lastly, one thing that's very important is to develop internal procedures for how to handle breach contracts and collectability. As we start to discuss more of the common audit topics, one that particularly pertains to the bonus structures and can be attributed to like the clawback and retention bonuses is the need for a collectability policy. We've seen in the past where clients will have these bonuses that get breached where maybe an employee doesn't stay the full 5 years that's stated in the contract, and then collectability is up in the air and it's sometimes difficult for the employer to collect. So that's going to lead us into our next slide, which is common audit issues. The first point, which I just touched on, is determining the collectability of bonus amounts after breach contracts and making sure that the employer has a policy in place. It's really key to protect yourself with this, and then to also be able to back up your policy if contracts are breached. The second common audit issue that we see around bonuses is the consistent application of bonus amortization. And what we see is that comparable financials can sometimes show as non-consistent or appear materially misstated if bonus amounts were booked in 1 year and then not paid out the second year, and there's reversing entries or vice versa. So that's one thing to pay attention to. And then lastly, recording bonus liabilities per the terms of the contract is also another common audit issue where we're looking for accuracy and to determine that the right amounts are recorded and then treated the same way and consistently. So that is going to lead us to our CPE question number 1. So CPE number 1, the question is, what type of incentive is offered by an employer to increase the odds of hiring a candidate? Option A is a retention bonus. Option B is a sign-on bonus. Option C is a performance bonus. And option D is none of the above. So we'll give you a few minutes to answer these, and then Felicia will close the CPE poll and we'll discuss the results.
I'm not sure, Zach, if you can see the answers, but we have 93% answering sign-on bonus, 5% answering retention bonus, and 2% answering none of the above. Performance bonus had no responses.
Awesome. Well, it sounds like most of everybody got it correct. It was the sign-on bonus, which was the correct answer, which really is offered to incentivize the chances of hiring somebody as compared to a different employer in a competitive market. So awesome. We will move on to our next section now, which is deferred and share-based compensation. So once we get into deferred compensation, which is something that we anticipate seeing a little bit more with the changes in the economy and the decrease in production. To kind of touch on what this is cash deferred compensation plans are arrangements with individual employees that provide the deferral of cash payment for services to a future date, which is commonly seen after retirement. The two types of plans that we're going to touch on today are qualified and non-qualified deferred compensation plans. So to kind of back things up, the reason that we're looking at this differently in these years, and we're expecting to see different strategies, is the decrease in production has made companies operate differently. The different strategies that we see with compensation can have different effects on your financial statements and the disclosures in them. So our goal today is kind of to go through these strategies and pinpoint the different routes to compensate your employees. The first one that we're going to show is rewards, which include examples like year-end bonus or commission. And these are often paid within a short time of year-end or after they are earned. The second type, which we've already touched on these as well, is retention, which we have touched on the basic 710 side of things, but the second bullet point examples include stock options, STARs, or other non-qualified deferred compensation strategies. We're going to dive into those a little bit more as well, because they do have different implications. And then these are also paid when the predetermined service period has been met. And then lastly, the last bucket we have is retirement, which is going to be additional compensation that's available for the employee when they retire. Common examples of this are 401ks, pension plans, and other non-qualified deferred compensation strategies. And these are going to be paid upon retirement. So we're going to dig into these a little bit more here. But the typical examples of what could prompt a deferred compensation plan would be needing to give your employees additional compensation, trying to retain employees, trying to make employee retirement more appealing to employees, and then also as a tax deferral strategy for employees, which we'll discuss a little bit later as well. So how to account for deferred compensation under ASC 710. As eligible employees attain full eligibility, the company will record the present value of their portion of the obligation in accordance with the contracts. The eligibility is going to be attained when the employee has rendered all of the service obligations necessary to receive the benefits stated per the contract. And then going down to our next point is the deferred compensation liability shall be adjusted with a corresponding charge to compensation cost to reflect changes in fair value of the amount owed to the employee. And the common adjustments that we see to this liability are caused by mortality or employee termination rate typically. So next, to kind of make things look a little bit simpler, we're going to dive into a really simple deferred compensation entry. So to read through the example here, we're going to suppose that company number 4 enters into a deferred compensation contract with its CEO. The CEO is 5 years from retirement as per the employment contract terms. Company number 4 agrees to pay the CEO for 3 times their current salary as a deferred compensation plan. So the metrics that we're going to use to kind of put this example together, the CEO has a current salary of $100,000. The present value of this annual pension plan is $300,000, and the lump sum amount in case of early death is $200,000. We continue it here, and the calculation for this deferred compensation entry is going to be total compensation, which is going to be the 3 years that they agreed to pay him his salary of $100,000, so a total of $300,000. And then we are going to take the annual compensation expense, that $300,000, for the 5 years left before retirement, and then in turn creates the entry for annual expense of a lump sum at retirement would be $60,000 debited to deferred comp expense, and then $60,000 credit to the deferred comp liability. For the tax treatment of deferred compensation plans, we have a little chart here that goes over the qualified versus non-qualified plans. We're just going to briefly touch on the tax implications here and fully advise that you reach out to your Richey May tax contact with any further questions or clarifications that you might see here. But just to include these, we did put some basic high-level information for the tax treatment of deferred compensation plans for the employer on this slide, which I'm not going to go over too much in depth, but you guys will get the slides afterwards. And then the next slide is actually the tax treatment of deferred compensation plans for the employee. So you can compare these two slides and look at the two different implications for qualified versus non-qualified. And then once again, with any questions that come up, or if you have, or if you'd like to strategize or talk about, one method versus another, reaching out to the Richey May tax team is a great avenue to go down for that. Next, we're going to talk about share-based compensation. These share-based payment arrangements are ways for entities to use share-based awards to reward and retain employees. And we typically see this in times where companies are trying to reduce their cash expenditure, and typically see this run through equity or liabilities. So what we're going to show you now is the differences between these equity and liability classifications. The determination of the liability classification is based on the award substantive terms, the award's repurchase features, if there are any, and then any award conditions other than service performance or market conditions. So generally, rule of thumb is if the award is to be settled by issuing shares, it would qualify as the equity method of classification. If the award will be, can be, or has historically settled in cash at the employee's election, it would be treated as a liability. So these are the two really important factors to think about for any existing share-based plans or any future share-based plans. Next thing we're going to talk about is the measurement date and value and how these differ between equity awards versus liability awards. For equity awards, the measurement date is going to be your grant date. Fair value is going to be measured as of the date that it's measured. The value for equity remains fixed unless there is a modification. And lastly, for equity, compensation cost is recognized over the requisite service period. Now, liability awards differ in that the measurement date is actually going to be your settlement date. And then the difference with liability awards is that non-public entities can actually elect to measure liability awards at either fair value or at intrinsic value. Typically, we see an intrinsic value measurement if fair value measurement is hard to obtain or is unreasonable, but that is up to the non-public entity to choose which method they elect. Their only responsibility is to make sure that they are consistent with their application of the method. So next, for compensation costs for liability awards, this is going to be recognized over the requisite service period and then recorded as catch-up adjustments to compensation each period for any changes in fair value. Now, there are various different types of share-based compensation, but we wanted to share with you 5 that we typically see or we feel that we see more commonly. The first is going to be restricted stock, which is stock granted in which the sale is prohibited until a certain time frame. The next is stock settled stock appreciation rights, which is a contract that gives the employee the right to receive stock net of any appreciation from the grant date to the exercise date. Similarly, we have cash settled stock appreciation rights, which is the same, although the difference is going to be settled in cash instead of stock. The next one that we see is phantom stock, which is a promise to pay a bonus based on the value of the entity's common stock, which is typically paid over a certain period of time, unlike SARs. And then lastly, we have stock options, which are contracts through which a seller gives the buyer the right, but not the obligation to buy or sell a specified number of shares at a predetermined price within a specific time frame. And so as you can see here, some of these might fall into different categories based on 710 versus 718. So the next thing we're going to go over is a flow chart that kind of breaks down these differences when trying to decide whether compensation should go through the guidance of ASC 710 versus ASC 718. Essentially, as an entity begins by assessing the features of the profit interest award and determining the appropriate model, you'll end up going down this left side, which is 710, or the right side, which is 718. 710 typically is general compensation, and 718 is typically stock compensation. However, there is some overlap between the two. The scope of ASC 710 includes performance bonus, profit sharing, and specific deferred compensation contracts, but excludes stock compensation plans. And then stock compensation plans are directly under 718 themselves. Now we move into management's responsibility regarding deferred and share-based compensation. The first responsibility is to determine whether any deferred or share-based compensation plans exist. I know that, as our audit firm, one of the common issues that we've seen is failure to disclose these correctly or failure to disclose these plans at all. And sometimes it comes down to just it kind of slips through the cracks. But sometimes we will be reading through board minutes or we'll be having conversations and we'll hear about these new plans, and the implications of these plans require us to disclose them on the financial statements, and some of them require initial entries or annual entries. So the next responsibility of management after determining whether you have any of these compensation plans is determine the proper method for accruing deferred compensation. Like we discussed, that guidance kind of starts with the flow chart between 710 versus 718. And then from there, you can kind of boil down where your guidance lands and how the accounting should be treated. And like always, with any questions that come up, you can always reach out to the Richey May team and we can look through your plans and help you decide what the best avenue for recognition is. The next responsibility for management is to determine the proper method for recognizing this share-based compensation, which we just talked about. And then lastly, inform Richey May of any changes or any new compensation plans as soon as possible, And that way we can get ahead of any financial statement disclosures, implications, calculations before audit fieldwork begins. So the common audit issues that arise, we kind of touched all these already, but the big one is not recognizing that these deferred compensation or share-based compensation plans exist. They can lead to initial entries to recognize this impact. And then also financial statement disclosures will have to be calculated and presented with their separate footnotes. The next is that improper classification of share-based compensation can lead to adjustments and/or recommendations. We have seen this where somebody thinks they're liability method and realistically it was equity method, or vice versa. And so those kind of situations can lead to adjustments for sure. The next is failure to recognize costs of service that have been accrued for on the balance sheet. And then lastly, having a lack of valuation model or third-party value pricing for any public entities that didn't elect intrinsic value. Next, we're going to bring up CPE question number 2. This poll question reads, what situations can lead to the need for a deferred compensation plan? Answer A is going to be the need to retain an executive employee. B is going to be the need for expertise or consulting from a former employee after entering retirement. Option C is going to be the need for expertise or consulting from a former employee that is working at a new employer. Or option D is going to be all of the above.
We'll just hang on a few more minutes to make sure everyone gets their credit and puts their vote in. A few more people that need to vote. Almost there. I think a couple people. Just want to hold it open to make sure everybody can get in. I want you to get that credit. Okay. I think I will close the poll now and share the results. Hopefully you can see that. If you can't, I'll just read through it. 52% answered the need to retain an executive employee. 2% answered the need for expertise consulting from a former employee. And 46% answered all of the above.
Wow, so that one was a little bit more divided. So we'll talk about this one a little bit. The correct answer actually was D, which is all of the above. The need to retain an executive employee can definitely lead to a deferred compensation plan by offering additional incentives that are paid at a later date. So A would work. B, the need for expertise or consulting from a former employee after entering retirement. We also see these as well under typical deferred compensation plans. And it's really if you have a key executive employee or somebody that was very crucial to the operations of the business leaves and you need them for a couple more years, or you just need additional help. And then C, the need for expertise consulting from a former employee that is working at a new employer. This actually can fall under the realms of deferred compensation as well. So D was the correct answer for all of those, but that was definitely a harder question. Oh, all right, well, next I'm going to hand it over to Shane, who's going to talk to you through our next 2 subjects.
Thank you, Zach. So today I'll walk through common audit issues caused by the new CECL guidance, which stands for Current Expected Credit Losses and Loans Held for Investment. And just as a note, Chad Murphy, audit partner, and Christina Lucas, senior audit manager, did a great webinar a few weeks ago that went into a lot more detail on CECL and its impact. So if you couldn't attend that webinar and would like a copy of the slide deck, don't hesitate to reach out and we can provide that to you. So how did CECL come to be? Well, in years prior, banks could not recognize future expected losses in the loan loss reserve due to the guidance in place. So fast forward to 2016, the FASB issues the CECL Accounting Standards Update, which for private companies goes into effect this year. And there are several areas CECL will affect, like service and advances, construction loans, available for sale debt securities, but we feel that the biggest effect to the mortgage industry will be loans held for investment, while areas like loans held for sale and derivatives are not impacted. And just as a quick plug, and to give you a heads up, there's a webinar coming up in a few weeks that will go over CECL's impact on servicing advances. So if you're interested in learning more about that, definitely sign up for that. Moving on, the updated methodology immediately records the full amount of credit losses that are expected, and it removes the concept of probability. So going forward, an allowance for all expected credit losses over the life of the asset should be established. And this allowance should factor in reasonable and supportable forecasts to determine losses. And before I get into the impact of transfers of loans held for sale into the loans held for investment category and vice versa, let's first define what they are. So loans held for investment are loans originated or purchased in which they have the intent and ability to hold for the foreseeable future or to maturity or payoff. And keywords here, as you can see that are bolded in red, are intent and ability, right? If you have an aged loan that you plan to sell once you receive a reasonable bid, that's not a loans held for investment, that's just an aged loans held for sale. And loans held for investment are also held at amortized cost. And this means that you're relying on the future cash flow of the asset versus a future gain received when you sell the loan, as seen in loans held for sale. So those 2 points are kind of the 2 key differences between loans held for investment and loans held for sale. So loans transferred from loans held for sale to loans held for investment. This occurs when the lender, again, has the intent and ability to hold a loan to maturity or payoff. When this happens, any fair value that's previously recorded is reversed as of the transfer date, and the loan is recorded at its amortized cost basis. Additionally, the lender will determine if a credit loss allowance is necessary in accordance with the new CECL guidance, right? And then when a loan is moved from loans held for investment to loans held for sale, the lender no longer has the intent and ability to hold to maturity, and the allowance will be reversed out. Third common issue we see is classifying an aged loan as loans held for investment, as I just mentioned, right? If you still plan on selling the loan once a reasonable bid is received, that's not loans held for investment. And because of the new guidance, a policy should be created to document a systematic methodology to determine the allowance. What is this allowance based off of? Well, there's a number of factors that can be considered and should be considered, like type of financial product, credit rating, interest rate, fixed or variable interest rate, location of where the loan was originated, and a number of other factors. But loans held for investment should be pooled based on those characteristics, and a model should be utilized to evaluate a potential allowance. And one thing I like to emphasize here is that the credit allowance should not be a part of the loan loss reserve. It should be recorded as a contra asset account against loans held for investment. And lastly, it's important to apply the correct valuation method and to make sure that future forecasts are factored into the valuation, not just historical data. And again, to reiterate, hammer home this point, aged loans are not loans held for investment. These are loans that you have the intent to sell, thus are not impacted by CECL. However, I want to note that we typically want to see scratch and dent bids for all late aged loans held for sale, as this will impact the fair value of the loan, right? If an aged loan has a scratch and dent bid, the fair value of the loan should be marked down to that price. Loans held for investment is impacted by CECL, and that's when the lender has the intent and ability to hold for the foreseeable future or to maturity or payoff. And for loans held for investment, we will want to see both the credit allowance methodology to support the amount of the allowance, and we'll also want to see copies of AVMs, BPOs, or appraisals to support the amortized cost that the loan is recorded at. And going forward, again, if you have any questions or concerns on the adoption of the new guidance, please do not hesitate to reach out to us at Richey May. Moving on to the next topic, business combinations, asset acquisitions, impairment of goodwill, and contingent considerations. Before I get into those last 2 topics, I'll walk through the differences between business combinations and asset acquisitions as seen in the guidance. And just because a legal agreement says it's an asset acquisition does not mean it would classify as one in accordance with GAAP. And in preparation for this upcoming year's audit, if applicable, we'll want a written policy or memo given the company's position of how this transaction is accounted for. So let's start out by understanding what each is and what the differences are. So a business combination is a transaction or event in which an acquirer obtains control of one or more businesses. And an asset acquisition is the acquisition of assets or a group of assets that is not a business. So the main difference between the two is whether or not what you're acquiring can be classified as a business. And after hearing that, I'm sure you're asking, well, what does the guidance define as a business? And to summarize the guidance, ASC 805, a business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return. Additionally, a business consists of inputs, processes applied to those inputs that then have the ability to contribute to the creation of outputs. So those are kind of the three elements: inputs, processes, and outputs. Inputs being any economic resource that creates or has the ability to contribute to the creation of outputs. Some examples are long-lived assets, intellectual property, internally developed software, and employees. Processes are any system or rule that, when applied to inputs, creates outputs. Some examples would be strategic management, operational, and resource management processes, while systems like accounting, billing, or payroll typically are not processes used to create outputs. And then outputs are the result of inputs and processes applied to those inputs that provide goods or services to customers, investment income, or other revenues. So to test whether or not the thing that's being acquired is a business, we'll follow the initial screen test. If substantially all of the fair value of the gross assets acquired can be concentrated in a single asset or a group of similar assets, that set is not a business and that can be treated as an asset acquisition. And while the guidance doesn't necessarily define what substantially means, it's typically interpreted to mean 90% or more. So to provide an example, if you pay X amount of dollars to acquire 100 LOs to boost production, that set of people is not a business as they are treated as a group of similar assets, thus costs incurred would be expensed. And is a branch a business? Well, that kind of depends, right? If the branch can operate independently of the company and has its own license to originate mortgage loans, that could be considered a business. And for this next part, I'll just go through a few examples and how they're accounted for under both business combinations and asset acquisitions. So research and development costs under a business combination, they are measured at fair value and can be capitalized. However, under an asset acquisition, they are expensed. One caveat there is they can be capitalized if they can provide an alternative future use. And given the still relatively new ASC 842 standard, I thought it would be useful to briefly talk about leases. In both instances, leases acquired would be measured as if it were a new lease under ASC 842. The only difference is if favorable or unfavorable market conditions exist. Under a business combination, the lease is adjusted, while under an asset acquisition, an intangible asset or liability is created. Then transaction costs are expensed as incurred under a business combination, while they're capitalized as a component of the cost of the assets acquired. And then contingent considerations under a business combination, they are recorded at fair value on the date of acquisition, whereas under an asset acquisition, they are only recorded when probable and reasonably estimable. Then goodwill. Under a business combination, goodwill is recognized. I'll talk a little bit more about that in the upcoming slides, but note that under an asset acquisition, there is no goodwill, right? Any excess consideration transferred over the fair value of assets is allocated to those various assets acquired. So as I just mentioned, goodwill is recognized in a business combination when the acquirer is willing to pay more for a business than the sum of the fair values of the individual assets and liabilities, right? It's an asset that represents the acquired future economic benefits. And ASC 350-20 provides guidance for the accounting alternative for private companies. A private company can make an accounting policy election to amortize goodwill on a straight line basis, beginning from the period of adoption. And this is typically over a period of 10 years. However, you can amortize it over a period less than 10 years if you can demonstrate that another useful life is more appropriate. But under no circumstances can goodwill have a useful life greater than 10 years. And this election also allows companies to evaluate goodwill impairment triggering events either at the end of a reporting period or during the interim, rather than throughout the entirety of the reporting period. So the steps outlined on this slide assume that the private company alternative policy election has been made. And firstly, you'll want to decide whether to test for impairment the entity as a whole or individual reporting units. Then you'll determine the frequency of the assessment. The impairment assessment is a trigger-based assessment. So this means that a company is only required to test goodwill for impairment if an event occurs or circumstances occur. Companies are required to evaluate for triggering events only as of the end of the reporting period or interim. Then you'll measure for impairment, and this is a single-step approach, which I'll get to on the next slide. And then lastly, if goodwill is deemed to be impaired, you can allocate the impairment charge to separate amortizable units of goodwill if applicable. So the test for impairment will start at step 0, the qualitative assessment. This is based on triggering events and have they occurred. Do these triggering events more likely than not cause the fair value of the reporting unit or entity to be less than the carrying value? If yes, move on to step 1. If no, that's the end of the assessment. Goodwill is not impaired. And then step 1 is the quantitative assessment. This is where we'll calculate the dollar value that goodwill is impaired. And in short, the impairment charge is equal to the difference between the fair value and the carrying value. And the carrying value cannot exceed, the impairment charge cannot exceed the carrying value of goodwill, right? You can't have negative goodwill. So for instance, let's say Prestige Worldwide Mortgage Co. has adopted the private company alternative election and has made a policy or memo stating that they elect to assess goodwill for impairment at the entity-wide level. During 2023, they experienced significant decreased production, decreased earnings, decreased cash flows, and this was determined to be a triggering event. So the company then performed an impairment test. They decided to do it in the interim, so they tested for impairment as of October 31st, 2023, and it was determined that more likely than not, the fair value of the entity had fallen below the carrying amount. So assuming that the carrying value of net assets was $1,000, the fair value was $700, and the carrying value of goodwill is $200, what would the impairment charge be that is recorded? Well, as I said earlier, the difference between the fair value and carrying value is $300, but because goodwill cannot be impaired more than its carrying value, the impairment charge would be $200. And some of the common audit issues we see in regards to goodwill impairment is not realizing that a triggering event has occurred. And these can come in a variety of ways and can often be specific to your company. One way is economic uncertainty, as I described in the last example. Additionally, let's say a product manager that was crucial to providing future outputs leaves, that can be a triggering event. Loss of a key customer, significant litigation, these are all examples of triggering events. And again, to reiterate, there is no goodwill in an asset acquisition, so that's why the determination between whether a transaction is a business combination or an asset acquisition is so important. And moving on to the last topic of the day, contingent considerations. The related guidance for this is ASC 805. What is a contingent consideration? Well, it represents an obligation of the acquirer to transfer additional assets or equity interest to the selling shareholders if future events occur or conditions are met. This consideration is recognized and measured at fair value as of the acquisition date. And the key takeaway here, to tie in what we talked about with business combinations and asset acquisitions, is you need to determine if the consideration is a separate transaction from the business combination. If so, then it's accounted for as compensation costs. A common type of contingent considerations we see are earn-out liabilities. They're often built into MSR sale agreements, as well as other various types of business combinations. And these occur when there are different expectations of a business between a seller and a buyer. It's a contractual provision stating that the seller of a business is to obtain future compensation if the business achieves certain financial goals. And the payer pays a portion of the sales price, which helps eliminate uncertainty, while the seller receives the benefit of future growth. And there are three ways that contingent considerations can be accounted for. Most commonly seen is a liability. This represents an arrangement that is required to be settled in cash or other assets at a later date. And the liability is measured at fair value, but then it's also remeasured at the end of each reporting date. And a contingent asset occurs when previously transferred contingent consideration is returned. Contingent gains are not allowed in accordance with GAAP, so a contingent asset is not a contingent gains. Lastly, it can be classified as equity, but going forward in this presentation, I'll just focus solely on the classification as a liability. So as mentioned earlier, contingent payments made as part of a business combination can be classified as either a contingent consideration or compensation costs. And note that a consideration is accounted for as a post-acquisition cost if the consideration is forfeited upon termination of employment. And I'll touch more on that in a couple slides. But for now, let's go through a few examples of indicators of a contingent consideration as opposed to compensation. And this is kind of taken from the guidance ASC 805. There are a number of indicators of a contingent consideration, but for the sake of time, I'll just describe a few of them in detail. So continuing employment. The terms of continuing employment of key employees or personnel in an acquisition may be an indicator of a contingent consideration arrangement. The relevant terms of continuing employment can be found in an employment agreement or acquisition agreement, and arrangements in which the contingent payments are automatically forfeited if employment is terminated, then this is compensation for post-combination services. Arrangements in which the contingent payments are not affected by employment termination may indicate that the contingent payments are additional consideration rather than compensation. Duration of continuing employment. If the period of required employment coincides with or is longer than the contingent payment period, that fact may indicate that the contingent payments are to be treated as compensation. Lastly, linkage to the valuation. If the initial consideration transferred is based on the low end of a range established in the valuation of the acquiring, and the contingent payment formula specifically relates to that valuation approach, that contingent payment can be additional consideration. However, if the contingent payment formula is consistent with prior arrangements, that indicates that the arrangement is to provide compensation. So to give you an example, in a business combination, Company A acquires Company B, and Company A believes that Employee 1 of Company B is crucial to transition Company B's ongoing operations. Per the arrangement, Employee 1 is to remain employed for a 2-year period after the acquisition date. upon which Company B shareholders will receive additional consideration. If employee 1 is not retained by the end of the 2-year period, how is this consideration recorded? Well, as I just mentioned, because the employee was terminated before the date specified by the arrangement, that would be treated as compensation. So to summarize, some common audit issues are the remeasurement of the consideration. How often should contingent considerations classified as a liability be measured? At the end of every reporting period at fair value. And if you recall, and again, measured at fair value. Additionally, you'll want to ensure you have appropriately classified the consideration as either a contingent consideration or as compensation. And there's a lot of nuance in this classification, so it's important to refer to the guidance in order to make that determination. And as always, do not hesitate to reach out to us for help. And lastly is ensuring the future liability is appropriately valued. And moving on to the third and final poll question. Was this webinar relevant to you? Does not apply to me, no, have not thought about it yet, or yes. And we'll give it a few seconds for everybody to answer.
Voting was definitely faster this time, but we do have a few more that probably need to vote. So we'll wait just a few more seconds. Okay, I'm going to go ahead and close it.
Okay, so the majority of you said yes, and that's definitely good to hear. And so at the end of the day, we're all here at Richey May to help. And our preference is to kind of review all these transactions as they come about and to have a discussion over what the guidance says and how it applies to these transactions. So to provide a quick recap of the common audit issues seen in the 4 topics Zach and I talked about, making sure that the different types of bonuses are accounted for properly and recorded in accordance with the contract or agreement, and then determining the collectability of that bonus. And then failure to recognize when deferred compensation or share-based compensation plans exist, or improper classification of those compensation plans. Then understanding how the new CECL guidance impacts loans held for investment and ensuring that a valuation model is used to create a credit allowance against loans held for investment. And then lastly, ensuring that you've properly classified a transaction as either a business combination or asset acquisition in order to properly account for the various assets that have been acquired. And yeah, there's a lot of nuance within all these 4 topics. The accounting guidance is very extensive. So again, do not hesitate to reach out to us if you have any questions or concerns. We always prefer to review these transactions as they come about, as opposed to in February and March when we're in the weeds of all the audits. So now I'll open it up for questions.
We have one question that I'll go ahead and answer. Is there a way to get a copy of the slide deck? Yes. In about 2 or 3 business days, we will send a copy of the slide deck in addition this recording. So you'll be able to listen to it in its full entirety. If you would like to ask a question, go ahead and unmute yourself. I believe we can have some additional commentary. We have 2 other members of our team on the line right now. If you'll go ahead and flip on your cameras, guys. We have Chad and Christina joining us. Chad Murphy, audit partner, and Christina, senior audit manager. And I think you 2 wanted to add just a little bit of commentary.
Yeah, we just wanted to build Shane's going through that business combination and asset acquisition, knowing if you're on the buying side, just because it's happening a little more often than not, you know, this year, last year, maybe the year after, of just knowing there's kind of three main situations of a business combination, asset acquisition, or even just startup costs, like what are you actually buying? And then coming into play when we're thinking audit time of, you know, startup costs, it is what it is, kind of expense kind of thing. And then asset acquisition, having there being no standalone trial balance, like there could be a branch P&L associated with that, but we're not seeing like consolidating schedules or a need for a separate standalone audit. And then business combination, there could be a requirement for consolidation or another standalone audit, depending on the licensing. And Chad, do you want to add some color to that?
Yeah, I mean, I think the biggest thing to take away from that, and the most prevalent of last year and this year, is the acquisitions, the mergers happening a lot more in our industry. So I think, you know, historically, we've always reverted to business combination, which, you know, majority of the time could be right, but a lot of the agreements may say business combination or an asset acquisition, but that's a legal agreement, a lot of tax advantages within those. So you definitely need to go through defining the business criteria to understand if this is a business you're acquiring or is assets only acquiring, because there is significant implications in your accounting treatment, particularly in Goodwill. I think not a lot of people get evaluations that are firms that are out there, so they'll kind of just throw everything to Goodwill, but with an asset acquisition, you're not allowed to have Goodwill. So that's significant as far as then revaluing those assets to what you did purchase, which then could imply impairment. So I would say that's probably the most important things that we want to hone in on. So if there is any mergers and acquisitions, please contact us and let us know how we can decipher that agreements and guidance for you.
Great. At this time, I don't have any more questions, guys. Just a reminder to everyone that if you do have a question after this webinar, please don't hesitate to contact either your Richey May point of contact or just at the info@richeymay.com mailbox, and we'll make sure you get an answer right away. Just want to again say thank you for joining us today, and we hope you found this presentation valuable. Again, as a reminder, the slide deck and recording will be sent out within the next day or two. For those of you who qualified for CPE, you will receive your certificate in a separate email in the coming weeks. And just one last reminder, we really want to make these valuable for you, these events. So please fill out the survey that will be coming in just a few moments to you so we can make our future events even more valuable for you. Thank you again, and we hope to see you soon on another Richey May webinar. Have a great day and a great weekend.